the big risk for the economy is what happens to the stock market. Because if the high end stops spending on luxury goods and high-end restaurants and cruise lines and cyclical spending, if that dries up because the stock market doesn't continue to play ball, I think this economy, especially in the second half of the year when a lot of the short-term stimulus falls by the wayside, is going to be showing some significant strain.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The administration tells us that a new golden age for the American economy is now underway and that we should see substantial material incremental GDP growth this year from the policies that it put in place through acts like the One Big Beautiful Bill, tax relief, deregulation, tariffs, and new trade deals purporting to bring trillions of new dollars of foreign investment into the U.S. Today's guest, however, is much more skeptical of the promise of these policies as well as the overall prospects for the economy. And now the U.S. is at war with Iran. How will that impact the situation? For guidance, we turn to the highly respected economist and award-winning researcher, David Rosenberg, founder and president of Rosenberg Research. David, thanks so much for joining us today.
Great to see you again, Adam. Thanks for having me on.
Hey, well, my pleasure. I'm very excited for this. We got to hang out in person in January, I think it was, at the Vancouver Resource Investment Conference, and we were actually on a panel together. And I kind of knew the end of the panel sort of pitched the softball about the administration's policies because I kind of figured it was going to be like a big juicy red steak for you, and it certainly proved to be that way. We just didn't have a lot of time to talk about it in the remainder of that panel, so I wanted to bring you back here on the channel to give you as much time to elaborate on it as you want. So why don't we start there, David? Why are you so skeptical of the administration's of their purported coming benefits of their economic policies?
Well, it really depends on your time horizon. If you're going to ask me, are we going to be getting decent growth in the next couple of quarters? The answer is yes. So I'm not going to totally dismiss the impact of the income tax refunds, which are significant. The question will be how much of that will find its way into the economy. But that's really a temporary boost, right? Like that is not something that any investor should be capitalizing. It's not a permanent tax cut. It's just the withholding tables allowing for these refunds that'll give us, 2, 3, 4 months of some better retail sales activity. But then that's just going to borrow growth into the present from the future. So I think the second half of the year, we're going to have a bit of a vacuum on that side. So this is not like the cash giveaway from Uncle Sam to the proletariat back in 2020, 2021, which is a gift that kept on giving. So this will have an immediate but short-term boost to the economy. The other aspect, which has really nothing to do with the administration, I don't believe that the bonus depreciation allowance is going to lead to a phenomenal incremental increase in capital spending. Our work has shown that the impact you really measure in basis points, not percentage points. But there's a lot of camouflage out there, Adam, because you can point to the economic numbers and say, as a politician or a president, well, look at what my policies have done. But I don't think that the introduction and advent and proliferation of generative AI and ChatGPT happening towards the end of 2022, which put an end to the cyclical bear market equities at the time. I don't think you can say, oh, well, President Trump is responsible for the AI boom any more than, President Clinton could say, well, I created the internet boom because I was around in the mid-1990s. Evolution is evolution, and inflection points on the technology curve can happen with anybody in office, Democrat or Republican. That's just the beauty of the ingenuity and creativity of the US economy. The bottom line is that if you strip out the AI boom, you actually have a recession in old economy capital spending. I mean, we got those fourth quarter GDP numbers. Industrial sector CapEx was actually negative. So what we don't talk about is how this AI boom, as strong as it is diverting resources away from other parts of capital spending. So that's the first point I would make, is that we do have an AI boom. And I'll tell you right now that a recession is probably off the table for the next several quarters, just from all these spending commitments alone. That has nothing to do with the president's policies. And then on top of that, we have, up until just the past little while, we had an unrelenting bull market in equities. And so even in the face of what you can really acknowledge is a very soggy labor market, I mean, in the past year, there's been practically no growth in employment, whether you look at the non-farm payroll survey or you look at the ADP survey, there's been almost no growth in employment. But yet consumer spending has been chugging along at, call it, roughly a 2.5% annual rate. And that's with practically no job growth when you smooth out the monthly wiggles. And real organic disposable income growth has also been close to zero. So what's happening here, that you have this widening gap between incomes and spending, which means that the savings rate has been on an epic downtrend. And that's been the primary source of support for the economy, is the fact that spending is hung in, and primarily because of the equity wealth effect for the top 10%. But that's the equity market speaking. That's not about the president. I mean, the stock market did just as well under Bill Clinton, if not better, and under Barack Obama than it did under President Trump. That's not about the president. So we have an epic drop in the savings rate. That's accounted for half the economic growth since last spring. And you have the AI spending boom. And so that's the story of vitality in the US economy. And so my answer back to you then in Vancouver and today is that none of this has to do with presidential policy. If you're going to talk to me about the success of presidential policy, explain to me how it is that if there's one item, of course, to his personal benefit and his family's benefit, which has been crypto, if Donald Trump has been so successful, why to this day is, Bitcoin still roughly 50% below where it was last fall? Like, has that been successful? I don't think so. So the economy is doing what it's doing. I think actually we get wrapped up in the AI craze, which is definitely adding to GDP growth. But when you do the bean count on the economy, and the major contribution has really come from the equity wealth effect on spending at the high end, that's been over half the GDP growth over the course of the past year. That has been absolutely monumental. So the big risk for the economy is what happens to the stock market. Because if the high end stops spending on luxury goods and high-end restaurants and cruise lines and cyclical spending, if that dries up because the stock market doesn't continue to play ball, I think this economy, especially in the second half of the year when a lot of the short-term stimulus falls by the wayside, is going to be showing some significant strain.
Okay. All right. Sorry, I just want to make sure I caught your last point there. I heard you saying that the big risk to the economy is what happens to the stock market, because obviously that sort of has become the tail that's been wagging the dog. And if there is weakness in the stock market, I think you expect to see economic weakness. I thought I heard you use the word economic strength. Did you mean that, or did you mean weakness?
Strain.
Strain. Thank you.
Strain.
Okay,
Not strain.
strain. All right, great.
But you made a very you made a valid point. When I started in the business in the mid 80s, the strategist would go to the economist and would say, well, what's your GDP forecast? So I could plug it into my model and come up with my S&P 500 target. But you see, today, it's the economist that goes to the strategist and says, tell me what your S&P flashing because I need that for my savings rate assumption so I could generate my consumption forecast to generate my GDP call. So you're right. It's the what's the head and what's the tail. Um, there's always been a symbiotic relationship between the stock market and the economy, but now the causation runs in a completely different way than it did when I started the business 40 years ago. The
Okay,
stock market is
I'm
the
trying not to
stock
ask this
market.
as
The stock market's driving the economy. And if you go back to the that last epic bubble that burst, back in 2000, remember the stock market rolled over, and then the economy rolled over.
Mhm.
And so it's not just that the stock market is quotes a leading indicator; it's the fact that it's so closely tied to consumer spending today. Uh, you know, Again, when I started the business, you learned about the capital structure. You learned about what's on the balance sheet of company X is debt and equity, and companies would actually issue equity to fund productivity enhancing expenditures. Well, nobody's issuing equity today. They'll issue debt, but you'll get whacked by your investor base if you ever issue equity. If
Mhm.
anything, you get rewarded for buying back your equity. No, what's happened over time is that the stock market's become this speculative vehicle for the proletariat to get rich as quickly as possible. So that's why we talk about the wealth effect more than we ever have before. That's why, unlike other decades, moves in the stock market like we've seen the past year, couple of years, can trigger such a dramatic decline in the savings rate in support of spending. And when I talk to a non-economist about the savings rate, their eyes just glaze over. Like there's the professor economics 101 talking about the savings rate, but I would argue that it's the most important behavioral aggregate in the national accounts at the margin, spread across 140 million households. That decision at the margin, how much am I going to save or spend out of my after-tax dollar? You multiply that over the population, it has a massive impact
Massive
on
impact.
economic
But it's
activity.
not
And
a
like I said before,
not a
like I said
sustainable
before,
one at this trajectory,
over
right?
half the growth, over half the growth of the economy the past year, you can trace back to what the stock market's doing and not what it's doing to fund capital investment, but to make people feel wealthier and then more comfortable to spend more of their current income. That's the story. That's not a presidential story. That is a human behavior story. And that's what I say, that if the stock market sputters, I'm not even saying going into a bear market. I'm just saying if it stops going up, the savings rate, which by the way, today, call it roughly 3.5%, is less than half where it was the pre-COVID norm. Imagine if we ever embark on a classic Bob Farrell rule number one, mean reversion on the savings rate. Unless we have a personal income boom, we would have a significant consumer recession.
Hmm.
And what I'm trying to say here, not to scare anybody, but just to say that there's more fragility behind these economic aggregates that you see on Bloomberg or you see on CNBC or on Fox Business or on Bloomberg, and all you see is the headline. My contention is that there's more fragility behind those headlines than meets the eye. And if the stock market stops going up and the savings rate starts to go up and not down in the face of a labor market that is still showing cracks, it's not imploding. This no hire, no fire labor market backdrop means we have just utter stagnation, like no growth in employment in the past year. Is that a sustainable economic model? And then no growth in real disposable incomes beyond government handouts, not a sustainable model to continue to grow the 70% of the economy called the consumer, unless that savings rate just continues to go down. So much of this hinges on what the stock market's going to be doing.
All right. So obviously, I'm going to get in a moment to where you think the stock market might be going, but let me just dig into these risks of fragility that you're talking about here. So, yeah, I was trying to get to a point, a word that you just mentioned, which was unsustainable, which is as long as the stock market is doing well, the people who own assets, the top leg of this K-shaped economy, well, they can keep spending, and it's that party goes on for as long as the stock market continues to rise. The bottom half of the K, which is, sorry, the bottom leg of the K, it's much more than half. I'm going to say, just for argument's purposes, let's say it's around 80%. they don't have the benefits of rising stock prices. So as their saving rates goes down, right, as they're basically funding their lifestyle from savings, there is an end date on that. That can't continue forever, right? That's not sustainable.
Well, there's actually two items worth noting. The first is 100% correct, that top 10 or 20% is carrying the load. They are spending freely uh, because of their equity market wealth going up as much as it has. But you know that the bottom and even part of the middle class, they've been hanging on. They've been hanging on. Now, they're not going out to restaurants beyond, say, Happy Meals and McDonald's. They're not going on fancy trips. They're not going to the casinos. They're spending everything on necessities. And even there, they are barely hanging on. And what is keeping them sustained is credit. Like if you look at the data, credit card expansion has been incredible. And the buy now, pay later, the BNPL, that is a huge craze that's been keeping the low and even the middle end intact. And that's something else that we have to consider, because if it wasn't for the credit valves for the low end of the income spectrum, they'd be forced to cut their spending on the essentials, like groceries, like food, uh, toothpaste, soap. But they're hanging on. I mean, they are. I mean, can you imagine the proliferation of these buy now, pay later policies? Can you imagine
Oh,
that people? You see, I keep on hearing about the consumer resilience. Really, like I'm at this stage, and this is what I'm talking about: digging beneath the surface. That there are people out there, and a lot of them, that are making installments, 40 installments on a pair of shoes. Think about
right.
that.
It's like
And all
financial life
people,
support, right?
well, all people talk about are the aggregates. Did you see GDP growth? And then they're thinking, I guess the really bear market is in economic analysis. Nobody wants it. They just want the head. Let's just give me the headline number. There is tremendous stress, as I said before, tremendous stress. I won't say strain. Stress is easier to pronounce.
Hmm.
Um, beneath the system. The lower end is only surviving right now on credit of all types at a time when you look at the delinquency rates in credit cards and in auto loans and in personal loans. Now, by the way, even though it's at a low level, the percentage of residential mortgages in arrears is hooking up. And that's more for the middle class than the low end, because the low end are renters. You go to the New York Fed's monthly survey, the Consumer Expectation Survey, and you'll see the share of low-income households who say they're not expected to meet their debt payment, their minimal debt payment in the next 3 months. That number is at the high end of the historical range. So the question then becomes for them is not the stock market. The question for them becomes at what point do the lenders to risky borrowers, seeing delinquency rates rise to the highest levels in 15 years,
Right.
begin to choke off that credit? So I don't know what the date of any of this is. I don't know the stock market. Look, it's been a great run. I do believe that the market moves in cycles. There's no such thing as a permanent bull market.
Hmm.
And then what happens when these lenders start to pull back on their credit availability for the very low end? Well, don't forget, because consumer spending on essentials still shows up in GDP. So that's what we have in our hands. We have these two forces at play that have dragged down the savings rate, because at the low end, don't forget, credit cards and buy now, pay later, they give you cash flow. But that cash flow does not count as income. That's not in the denominator
Hmm.
of the savings rate calculation. So I'm thinking that there could be a couple of things that happen. And when I tell people, say to me, what is it you're watching? When I'm watching this thing that tends to move glacially, but I'm looking for a reversal in this one particularly important aggregate that is very complex called the personal savings rate. And any sort of development, not even a shock, but a development that causes that to normalize. I mean, to get back to the normal trend of the past 5 decades, unless we get the denominator personal incomes really accelerating, the mathematics are going to be a very weak consumer spending backdrop. And so that's what I'm looking at. And I'll tell you why, because, you opened up this segment talking about the looming fiscal stimulus and the big, beautiful
Mm-hmm.
bill. Well, the big part of the big, beautiful bill was just not falling off the fiscal cliff by the extension of the tax cuts. But the refunds are all people are talking about. I cannot believe how short-sighted and myopic our industry has become, because that's the only questions I get. Can you give me what the GDP impact is going to be from the looming tax refunds? To which I say, sure. If that's what turns you on, you want me to give you a 3-month or 2-month forecast? Sure. So I'd like to delve into the things that other people are looking at. Where's the surprise going to be? What will the surprise be after these tax refunds? How much will be saved or spent? But what happens in the aftermath? So I have, shall we say, a rather skeptical view as to how the economy is going to play out, with or without Donald Trump's policies.
Okay. And tied to that then is obviously what's going to happen with AI CapEx spending going forward, because that's been a big factor over recent years. Um, Before we get to that, let me just ask you this. It's kind of a pessimistic question, but you're talking here about the lower class and middle class that are really just kind of hanging on by their fingernails right now, right? They're draining down their savings. They're relying on things like buy now, pay later, which, I mentioned is sort of like financial life support. Um, does it re In the current economy that we have, does it really matter what happens to the bottom of the bottom leg of the K? Meaning, you know, from what I can tell, the average number of consumer spending has been held up pretty okay, largely because the top end of the K just spends a lot more above its weight. And as long as they're doing that, and I hate to say this because it sounds so cold-hearted, but is it almost immaterial what the bottom half of the K is doing, as long as the asset party is raging enough that the top half of the K keeps their dominant spending going?
I'd say that there's a lot of truth to that. I just told you, two narratives about why the savings rate's going down. I think that the equity wealth effect on spending has been dominant, and the low end. I mean, they're spending on necessities. They'd rather not have to share one plate of pasta with a family of four
Right.
if they don't need to. But you're right. So they'll do what they have to do to survive. They are borrowing to survive right now because their job prospects are meek, and wage growth in nominal terms is subsiding at a time when inflation has remained, shall we say, stubborn. So that's impacted their real incomes. The high end has been the dominant force. Make no mistake about that. And that again comes down to why. Why has there been this shift in the curve of high end consumer spending? It certainly wasn't happening in 2022 during the cyclical bear market,
Hmm.
but it's been happening, and then it's really accelerated just in the past year. Um, and so the answer is yes, it's been the equity market, the impact it's had on wealth creation, but not just the wealth creation, but the psychology behind that it's
Hmm.
okay to continue to spend more and more of my after-tax income. Maybe the savings rate gets to zero. Nothing says that mathematically you could even go negative.
Right.
Um, Depending
As
on
long as the
what a
lenders
start,
still
well,
ask.
so,
Yeah.
so long as you know just borrow your brains out. But what I'm trying to get at here is that's been the principle. It comes back to the opening question about, I guess, if you believe that Donald Trump was the principal source of the bull market in equities, I don't really think any president, including Ronald Reagan, is that powerful that they can influence Mother Nature. The markets will just move in cycles, and the markets are incredibly driven by psychology. In fact, when you go back historically, you'll see that almost half of a typical bull market is multiple expansion, not earnings
Hmm.
growth. And then in a bear market, 80% of the bear market is the multiple contracting. That's what John Maynard Keynes famously coined animal spirits. Well, the economy isn't really driven by animal spirits, but the markets are. And
Right.
their markets are more volatile and go into far more amplitude in terms of uh, the magnitude of the cycle than the economy does. But you see, I would say that we've never reached a stage, especially now that 72% of the financial, the household sector financial balance sheet, in terms of percent share of financial assets, 72% is in equities today. Um, it's never been that high before. It's higher than it was during the dot-com craze. So everybody is all in at the same time, and everybody believes because you have a equity risk premium of zero or negative, that everybody believes that equities have become a riskless asset class. That's going to be, I think, the big surprise is what happens if we talk about mean reversion. What happens if the equity risk premium mean reverted or the price earnings multiple mean reverted?
Right.
And so the answer always is, well, valuations only matter when they matter. Yeah. And then you have your head sliced off.
Right.
So um, what I'm saying is that this is not as an economist who is focused on the fundamentals, and maybe that's what gets me into trouble. Because when you have a situation where real organic, when I say organic, I mean net of government benefits, real organic after-tax personal income is running zero year over year, but consumer spending is up 2.5 to 3%. That is a wide divide that is not a sustainable economic model. I'd actually rather have it the other way around. I'd rather have incomes accelerating and consumption weakening so that I could say, hey, we're going to get catch up. Consumption's going to catch up to incomes. That hasn't
Right.
happened yet, but that's why I'm bullish on the economy. But it's flipped. Like basically, outside of the wealth effect, what drives consumer spending is real incomes. Real incomes are flat. So you see what I'm saying here is that flat real incomes, 2.5% spending growth, and that 2.5 percentage point gap, Adam, is all the stock market
Hmm.
equity wealth effect on spending. And if that goes away, you know, you'll be at zero in consumer spending growth. And there won't be enough AI spending around to make up for that loss because AI is not 70% of GDP, nor will it ever be, but the consumer is. So that's really what's at stake here. What's at stake here? Uh, so all I can say is who knows what the stock market's going to do? I mean, I have my views. There's a wide confidence interval around those views, but I'm just going to say if you're a macro bull, I wouldn't be pointing to Donald Trump's policies. I'd be praying if you're a macro bull. If you're praying for the Fed to not cut rates or praying for higher rates, praying for an ongoing consumer spending binge, you better be hoping that this bull market is going to stay here for a long time because that's
Right.
what's driving the biggest part of economic growth.
All right. So you're taking exactly where I was sort of building up to, where the whole system right now seems to be spinning around pretty much just one axis, which is the market, and the market's continued upward trajectory. So, David, we're coming off of 3 years of pretty much 20+% returns in the markets. So just statistically, a fourth year being that good, the odds are not high, just statistically. Now you've got some reasons to be skeptical, as you've already mentioned here. Um, Obviously, if you're praying for this bull market to continue, you've really got to be praying for the kind of AI miracle to continue because so much of what's been driving the market has been the appreciation of the hyperscalers, due to all of the cash flow that they're now directing towards build outs of data centers and basically investing in one another and all that stuff. Now, this year we've seen a little bit of, or even we've seen notable capital rotation from growth, say, into value, but now we got a bunch of value stocks that are hard to call value stocks because their PEs are pretty stratospheric for those companies. So I guess, David, how concerned are you that the bull party will not sustain throughout this year and then bring everything down with it?
Well, look, the you're right that we've had this rotation, but you see, the thing is that people think that they're rotating into other sectors of the stock market and getting out of the tech trade, but they're all correlated. I mean, now because of the implications for the power grid from building all these massive AI data centers, energy is connected now. I mean, getting away from the war in Iran, energy's become connected with the AI trade. Utilities become connected with the AI trade. Of course, consumer discretionary through the equity wealth effect has been connected to the AI trade. In industrial products, uh, because of all the construction material that's been needed, has all tied. So you see, the things that very few sectors are not correlated with the AI trade. You could point to REITs, you could point to healthcare. I think you can point to consumer staples. I mean, that's pretty well it. It's all one giant correlated trade. And so I guess from my perspective, the complexion started changing a few months ago. And a lot of that has been all these massive multi-billion dollar capital commitments, which, yes, will provide a boost to GDP for this year. We'll see what happens next year. The question's now, how much overcapacity are we seeing? If you notice
Mhm.
that companies that are now announcing these mega billion-dollar capex plans, a year ago, 2 years ago, their stocks would fly. Their stocks are now going down. Their stocks are now starting to go down. The whole complexion has changed because now investors are starting to guess, how much dilution is there going to be? What's my ROI going to be now
Mhm.
from all this investment spending? So now there's concerns about overcapacity. As you'd mentioned, there's now new concerns about how this is affecting the disruption with other sectors across a wide gamut. I think you are starting to see it, by the way, in many segments of the labor market. People are saying it's not AI is not in the labor market numbers. I don't know. I don't know what data they're looking at. We haven't seen the peak yet, but it is starting to show up, at least from the numbers that I'm looking at. But this has been a concern too, that this is no longer, you see what's happened is that AI is no longer a tide that lifts all the
All
boats.
boats. Yeah.
And so it's becoming much more selective, and who are going to be the winners, who's gonna I mean, you can mention some large cap names in that space that will probably end up being a dominant player. um, Look, you can argue even that Nvidia's chips are special chips. They do have that monopolistic power. Um, you mentioned before, yeah, consumer staples. I've been a big fan of Walmart for years, but the multiple right now scares the bejesus out of me. And yet, I mean, there's another defensive growth company trading, I think, at a very attractive multiple called Microsoft. And so, look, there's areas that you can point to, but the whole complexion of that AI trade has changed. And it'll be interesting to see if all these estimates of what the TAM is going to be, the total addressable market, what that size is going to be. There's been so much money poured into this. As is usual, this is what happens with every bubble. And this is
Right.
a
You always
bubble.
overbuild.
I don't mean a bubble in a pejorative term.
Right.
This is about, the exuberance. The bubble is really more in investor behavior than it is in the actual technology. But then it does tend to lead to overcapacity, and that's what ultimately triggers more of the deflation that people talk about productivity. Kevin Moore's talking about with the productivity that'll come down the road. The productivity. I'm there thinking, well, what about the overcapacity?
Right.
Because ultimately, what brought on the deflation after the tech wreck was the overcapacity. Wasn't the productivity. That was a two-bit player.
Right.
So
Right.
yeah, so you're taking a look. You've seen the churn of the market, and when you're looking at it, I said before, the stock market just has to stop going up. And really, it stopped going up, you can say 3 or 4 months ago. I mean, heading into this conflict in the Middle East, the stock market really was hovering near the highs, but it wasn't making new highs anymore. But
I think right now, David, I think it's the same price it was at Halloween of last year.
yeah,
It's pretty much been flat. Yeah.
yeah. So this is where expectations come into it. I think that if you polled most people, if you actually look at the survey data, most people still believe we're in a bull market, notwithstanding the fact that we both know that we've just flatlined. It's just been a
Hmm.
gut-wrenching volatility, and that was happening even before the war with Iran. So it has to happen because when I talk about the savings rate, I say it's a behavioral aggregate. A lot of it comes down to expectations. So it's not just what the stock market has been doing, it's when is there a realization that we've reached some sort of change in the not in the regime. I don't mean the regime in Iran, but the market
Right.
regime. When you when the general investing public starts to realize the bull market is over, and let's say you and I agree on that, and actually it looks like it's, or maybe it's a resting spot. You see, most people believe we're just in a resting spot and heading to the next leg in the bull market. So that expectation that the bull market is still intact is what's still driving the savings rate lower, even though, as we said, the stock market hasn't moved much in the past 4 months.
Hmm.
These deeply ingrained expectations, and you see it in the market still, right? Like even intraday during the past few days of this conflict in the Middle East, you open up with the markets deep in the red, and then it improves in the afternoon because the buy the dippers, that mentality has become incredibly ingrained. And it's when all this psychology begins to shift. The psychology is what drives the market multiple. People don't. I hear about the earnings fundamentals. Yeah, I get it, but it's the multiple dominates. The multiple dominates in bear markets and bull markets, and the multiple is just pure psychology. The savings rate is pure psychology. A lot of what we're talking about is pure psychology. But we hit extremes when you get to a 40 Kate multiple, um, the second highest on record, um, a 2.5% real earnings yield in the S&P when you get a 2.6% real yield in the long bond. That's when I said before the ERP is actually negative. Okay, that's very interesting. That's when you get so emboldened as an equity investor, they actually believe that equities have become a riskless asset class. You see,
Hmm.
that's what the stock market investors believe. And that's what they're telling you. And they think that they'll never be. And I'll tell you that there's this belief that Mother Nature doesn't exist anymore, that cycles don't exist anymore, recessions don't exist anymore. All those are relics of the past in this so-called new economy. It does remind me a lot of the rhetoric, by the way, in the late 1990s.
Sure.
So I can't time it. I just like to sort of invest. I like to invest with the tailwind at my back instead of the headwind in my face.
Hmm.
I think that there are headwinds, and that has nothing to do with the economy, um, but it has to do with valuations, and it has to do with when is sentiment going to turn. Because sentiment is as off the charts as much as valuations are. Everything is, you know, everything is two. We're not even talking about one standard deviation events. They're two to three, whether you're looking at sentiment or valuations or the concentration of equities and household balance sheets. All these things have me very nervous because I do believe Bob Farrell's mean reversion. And then my bigger concern is what this does to the economy. Because if it does hit the economy, everything we're talking about, the stock market either going into a correction phase, bear market, or stop going up, cause the savings rate to go up. That reduces consumer spending growth, that cuts into earnings. Then all of a sudden, what is a multiple compression, say weakness in the stock market, becomes an earnings driven weakness in the stock market.
Hmm.
And then you get this self reinforcing spiral, which is a nobody's forecast. Nobody believes that could ever happen again. But, you know, that's the risk when Humpty Dumpty falls off the wall. That is the risk. That's the tail risk nobody's looking at. I'm not even talking about geopolitical tail risks. I'm not talking about that. I'm telling you, probably in 4 weeks, I'll turn extremely bullish on what's going to happen with the world. That's my own personal belief. But there's so many imbalances beneath the headlines. It bothers me actually that so many people just want the economists just give me the headline and then go away without trying to understand what it is that's driving those headlines. And I think that there is fragility. I said that before. Fragility and major imbalances in the economy. Boom in AI capex, recession and non-AI capex. You still have lingering malaise in the housing market and commercial construction. Global trade is still in disarray. That's been taken off the front pages because of what's happening in Iran. But global trade instability is still fully intact. And then we have the consumer, which is only alive because of the stock market. So all I'm saying is that things might continue to chug along. I'm just going to say that there are serious risks that it won't. And I think that investors have to pay attention to the balance of risks around their forecast. I would feel a lot better, I said before, if this was an income-driven consumer cycle, an employment-driven consumer cycle, I'd be feeling a lot better. But when I hear the Fed feeding the line about consumer resilience, which was like basically the opening line from Jay Powell at the podium after the last meeting, consumer resilience, because the headline drives you to that conclusion, without talking about how bizarre it is we have this resilience when we have a crappy labor market on our hands, no job growth in the past year, and no real organic income growth. Well, what's so resilient about that? I want the tables to be turned. By the way, when the tables do turn, which they normally do in an economic downturn, maybe this will be next year's story, and we get the gap the other way where consumption growth is lagging well behind income growth, I'll say, hey, look out, we're going to be in for a nice upcycle in the consumer, but that might be a 2027 story or 2028 story.
Sure.
But right now, I think people have to really comprehend that we are not in a stable equilibrium where incomes are rising, where consumer spending is rising with incomes. This is a rare period of economic history we have in our hands, and principally because of what the stock market's doing. I don't know, that doesn't make me feel that keeps me on edge, and it keeps me from being bullish on the economic outlook, those risks in particular.
Okay. All right. I'm looking at the time, David. I've got three important questions to get through with you in the next 15 minutes or so. So let's crunch on through. Given the importance of psychology in here, right, to keeping this thing going, as you've been talking about, what are the indicators that you're looking at to try to determine when the sentiment shifts from, hey, this is just consolidation and even better new highs are ahead, to, oh God, this looks like a topping process, and we need to start thinking about all sorts of outcomes that we haven't been thinking about yet?
Well, I consume the survey data like it's nobody's business. So there's the American Association of Individual Investors, the AAII survey, and that's telling me about the general public, how they're feeling about the market. Professional investors, I look at Market Vein. I look at the Investors Intelligence Poll to tell me if, and that's what I mean. Even when the market wobbles, these things don't change. It tells me that we have really well ingrained perception that a wobble is just a wobble, that we're not at a reverse point in the market. So I look at that as a sign of tremendous resolve by professional investors, individual investors. So I look primarily at the survey data to look for whether or not people are building in an assumption that the bull market is over. And so that these survey data points are very important to me from a psychological standpoint. And those are the three: AII, Market Vein, Investors Intelligence. That's all you need. And it's telling me that notwithstanding all the whatever angst, anxiety we get, that psychology that the bull market's still intact, that hasn't gone away just yet.
Okay. All right. Well, thank you. It's great to give people these indicators that they can look at themselves as well. Okay. So Iran, how, if at all, is that changing your expectations for the rest of 2026?
Well, I understand that there's a lot of air underneath the economic data. Okay. I don't trust an economy where there's no job growth. Are we relying therefore all on productivity growth? Let me give you an example. In the 1960s, you've got the microprocessing chips. And when you look at the data, productivity is going 2-3%, employment growth is going 2-3%. You go to the 1970s, with the mainframe, and productivity 2 to 3, employment growth 2 to 3%. You go to the 80s, Microsoft goes public in 1986. You get the software boom. Productivity is running 2%, employment growth is running 2%. If you go to the internet, if you go to the peak of the tech boom in the first quarter of 2000, both productivity and employment growth are running 2%. Right now, we have 0% in employment, and we have over 2% growth productivity. All the growth is coming from productivity. Giving another example of the imbalances in the economy. So this year could be great. Like, we know we got the income tax refunds, we got the capital commitments and the hundreds of billions of dollars from AI. I think the economy this year, on average, I'm using averages. I think we should be okay. The second half of the year, I'm a little concerned. 2027, I think there'll be an incredible vacuum because we'll be past the peak of the AI spending boom. We will not know at that point how much overcapacity there's going to be. Past the peak of fiscal stimulus. We'll probably have a change in the midterms, so they're going to have split government, which means fiscal gridlock. And then it comes down to what's the stock market going to do? I have a view on the stock market. It's not particularly bullish, but then again, other people have a different view. As I said before, you tell me your prediction on the stock market. I'll tell you where the savings rate's going, and I'll tell you what happens with the consumer. But I'll just tell you this much, that we should be very concerned about the K-shape to everything, especially the consumer from a social stability standpoint. We should be very concerned about an economy that's running on all the things we're talking about. Fiscal stimulus and AI spending with no job creation. With no job creation. So tough for me, and believe me, I'm not in the recession camp any longer. I haven't been for a long time. But that doesn't reduce my concern that benchmarked against expectations, I think the economy second half of the year is going to seriously disappoint. You have so much priced in. The consensus is so wildly optimistic that you don't have to have a recession call. But if you get GDP growth the second half of the year running 1 to 2%, and with that higher unemployment, that's going to be a big surprise to the markets and a big surprise to the Fed. And that's really where I'm at right now.
All right. Thank you. Again, the specificity is super helpful. So you're not looking too good, at least about the economy in the second half of this year. All right. Rubber meets the road. What type of investing strategy do you think is appropriate for the moment in time that we're in? And are there particular assets that you particularly favor or would particularly stay away from given these conditions?
Well, look, one of my recent moves was to extend bond duration out to the 30-year because I like where real rates are. I like where real rates are, and I have a very benign inflation outlook. I'm not nearly as nervous as a lot of the Fed hawks. So I like real rates, and I like how bonds are valued against the stock market. And I think inflation expectations are going to drop measurably between now and the end of the year. So
Okay.
I like the treasury market. I like all aspects of it. The front end I like as well because there's not enough Fed rate cuts priced in. The Fed has talked everybody out of it. I'm on the other side of the trade as the FOMC hawks, and
All right.
I like the long end.
So this is a gentleman prefer bonds
Yeah,
year.
yeah, exactly. Yeah, you remember my title to the one. Actually, I put that report out the day that the 10-year touched 5% in October 2023. There's parts of the stock market that I like. Obviously, aerospace defense to us has been a no-brainer, and one of the few sectors to be going up through this conflict with Iran. We've been long utilities, healthcare, energy infrastructure. In Canada, we've been favoring the pipelines. But most of our equity concentration, and people should know that in the Rosie model portfolio, I'm not 0% in stocks. In fact, we're 50% in equities. It's just that 15% of that has really been in the US. We have 35% in Europe and Asia. Um, and notwithstanding the fact that Europe and Asia are more susceptible to the disruptions we've had because of the war and energy prices, we still like that diversification in those other markets because they command just superior valuations. So
Hmm.
we like those particular regions, Europe and Asia. We like US bonds. We bought recently, we think there's too much inflation and RBA tightening, so we bought Australian bonds. And in the equity market, we're very sector specific. So like I said, the hard assets that spin off a revenue stream, we're very cash flow sensitive. So like I said, the pipelines, the utilities, energy infrastructure. We do like healthcare. We've been there. Yeah, equal weight. Again, one of our recent moves was into the equal weight consumer staples sector. We like consumer staples. We just don't want to. We don't want to own like two names, Costco and Walmart.
Yeah.
So we did and the equal weight consumer staples. So it's a very, shall we say, defensively structured, yield oriented, capital preservation type of asset mix that we have right now.
Okay. Do you have any gold in there?
Yeah, I
Obviously
forgot to
defensive,
mention.
but doesn't have a yield.
Good point. Well, I didn't want. Now you're going to get me carried away. We're going to spend another hour talking about gold. In fact,
Oh, God.
we were at the gold conference. We have trimmed our exposure. We when silver started looking like a dot-com stock, just
Hmm.
around the time of the conference, we blew out our silver and silver miners. But we're still somewhere between 5 and 10% on gold and the gold miners. It used to be higher, um, but here's this as well as I do that you don't make money till you book a profit.
Right.
So we've done that in gold. We like gold. We're just not we don't adore it as much as we used to. But
Okay.
I'll just tell you this much. I'll tell you this much, okay? Depending what happens in the Middle East, this could be a game changer for me. Okay, you might want to have me on in a month or two, because there's a risk, depending on how this goes, that I become a permable.
Okay. And obviously, I'm assuming if things go really well, you become a permable.
Well, I'm putting out a report where I'm saying we don't have to win the gold medal. The silver medal will be just fine. If we can, if you're at the safari and you confront the tiger, but the tiger has no teeth and no claws, you don't have to run away just because it roars at you.
Hmm.
So the silver medal is basically that Iran does not, the Iranian regime, because it might not go away. And I'm not really don't know anything about regime change. That's difficult to do from the air.
Yeah.
But defanging the root of evil on the planet, and then the next thing that happens is the Abraham Accords. When you think about bringing Iran into the global order, 90 million people, young, vibrant, educated population, bringing them into. I mean, this could be really big stuff. Bringing Iran into the world economic order, and not just that, but then paving the way for at least, say, economic relationships between Israel and the Gulf countries, other Arab countries. Well, I could tell you, we could be talking in a month time that I'm redoing my whole asset mix based on what happens out of this. Because I won't have any desire. I have no satisfaction owning global aerospace defense. In fact, I hate owning it, but I do it
Hmm.
because we want to make money. I would love to have an excuse to take that position off. So there, you have an incentive to get me back on sooner than 6 months, okay?
All right. And we'll call that the turning the swords into plowshares Rosenberg investment strategy. So, David, absolutely. So, first off, absolutely, that's a deal. I hope we are able to have you back on in a month, meaning I hope things go as well as you're hoping for. And if I can, I'd like to expand that discussion to not just include Iran potentially starting to normalize relations with with the West, and better trade inside the Gulf and stuff like that. But let's also add the impact. We'll just dream for a moment. Let's also assume the Board of Peace has its desired outcome, and that the aggressive hostilities between Israel and Gaza largely get tamped down. And let's assume that things go well with Venezuela. And let's assume, as is being talked now, that Cuba maybe has a friendly change in regime. What does that world look like, and what investment themes come out of all that? So, if that's of interest to you, I'd really love to have that conversation with you.
Absolutely. Look, it's all peace is a good thing. And the one thing I'll say with reference that I didn't mention before is what could come out of this. Imagine if the geopolitical risk premium in the oil price comes out permanently.
Hmm.
Uh, and all this will lead, everything that I'm thinking about right now is going to lead to lower oil prices. Donald Trump, but the question is, will it come in time for the midterms for Donald Trump?
Well,
Well,
that would be
but
super
no,
hard to assume, but yeah.
but then you'll have me back on, and I'll say, okay, I'm going to go back and say, yes, so there was one presidential policy that indirectly led to much lower oil prices without having to drill, baby, drill,
Hmm.
and that's a successful resolution out of this war with Iran because we take out the geopolitical risk premium of oil, we end up getting more production, and then Iranian production into the world supply. And then it's, I'll probably do another shift out of my oil, out of my energy exposure.
Hmm.
There's some things I wouldn't mind. I'd like to do a shift, a real meaningful shift, but that will breathe life into real purchasing power. That might get me bullish on the low end consumer. I
Hmm.
mean, mind you, they don't drive, so but lower oil prices are good for consumers everywhere. Even in the energy producing countries like Canada, consumers love lower energy
Right.
prices.
Well, it reduces cost of living, but it also boosts economic growth. So job
Yes,
prospects get better and you keep more of what you
100%.
earn.
Like I said, you had me on in the opening days of this conflict, but things could change. So, and I would love to come back because you know what? I tell you the truth, I love talking with you. Always
Oh,
have.
it's right back at you, my friend. And you know what we didn't even put on our list there, and this could be very oil friendly too, is a negotiated peace to the war in Ukraine. And if Russia starts normalizing its relationships with the rest of the world and its oil stops getting embargoed, that just adds even more tailwinds there. So let's all hope for that, my friend. And I hope I have you back on in a week in a month to discuss all this. Last question, but the most important for folks that would like to follow you and your work, David, in between now and your next appearance here, where should they go?
Well, you could either email me directly at drosenberg at rosenbergresearch.com or just go to the website, Google Rosenberg Research. You could go to information at rosenbergresearch.com if you want to sign on for a free trial. We'd love you to kick our tires. Uh, but if you have any questions or comments for me personally coming out of this, I'd love to hear your feedback. D Rosenberg at rosenbergresearch.com, and I'll get back to you.
You are a very generous and very courageous man to share your email address
Well,
publicly
I won't,
here.
but I won't share my phone number because that might get a little too personal.
That's very wise, I think. Well, David, look, when I edit this as normal, I will put up the links to all that. Folks, the links will also be in the description below this video. All right. Well, folks, look, please join me in thanking David for giving us so much of his time and expertise today, so much specificity around which assets he thinks are a good fit for this market environment. To show that appreciation, please join me in just hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. I also, two things. One, if you would like to get some help from a professional financial advisor in perhaps putting into practice some of the things that David has mentioned here, if you don't already have a good professional advisor who's already advising you, then recommend that you consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel every week. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. As a reminder, these consultations are totally free. There's no commitments involved. It's just a service these firms offer to help as many people as possible. Also, I just want to let you know that there's only a couple days left after this video airs to lock in your tickets to the upcoming Thoughtful Money Spring Conference at the lowest early bird price discount that we're offering. So if you haven't already bought your ticket, run now, don't walk to thoughtfulmoney.com/conference and buy your ticket now at that lowest early bird price. If you are a premium subscriber to our Substack, you'll also receive an additional $50 off of that price by entering the discount code that I've emailed you, so check your email inbox for that. As a reminder, the conference itself is taking place on Saturday, March 21st. Don't worry if you can't watch the event live that day. Everybody who buys a ticket is going to be sent replay videos of the entire event, all the presentations, all the live Q&A within hours of the event's conclusion. And as I've said many times already, this is the absolute best faculty we've ever had, and it probably may be the most timely conference we've ever done, especially given the recent events that are going on with Iran. The faculty includes the great Lacey Hunt, who will be kicking it off with his traditional keynote. He'll be walking through a whole new set of slides, offering his typical graduate level walkthrough of what's happening in the macro economy. He'll be joined by first-timers Ed Dowd, Michael Oliver, and journalist Matt Taibbi. We'll also be joined by Luke Groman and Brent Johnson, by Stephanie Pomboy and Grant Williams, by Michael Howe, the liquidity expert, and Darius Dale, by Judy Shelton and Danielle DiMartino Booth, by Rick Rule, by Andy Sheckman, by David Hay, by Melody Wright. I think there's one or two others, Lynn Alden, and still one or two others whose names I think I'm forgetting. But as you can see, it is just an absolutely fantastic, power-packed faculty. Really hope you can join us that day. So again, make sure that you, if you haven't bought yet, go right now after this video ends to thoughtfulmoney.com/conference. David, I can't thank you enough. It's always such a pleasure to talk to you, my friend. Like I said, let's hope we see you in a month for all those good reasons.
Good. I hope so too. Okay. All the best, Adam. Good seeing you, buddy.
You too. Everybody else, thanks so much for watching.
Most of it is leaving the COMEX, which is also very unusual. It's not going into the eligible category in the COMEX, it's leaving. So it's called a loadout. We're seeing massive deliveries and a lot leaving. Who's doing this? Same thing is true here in the West, where 40 plus central banks have pulled their gold out of the New York Federal Reserve, which would for 50 years give access to COMEX, and pulled their gold out of the Bank of England, which would give access to the LBMA. So they're taking physical possession, removing counterparty risk. So anyways, we see all this gold being delivered. Say several things that are provocative or certainly interesting, and that is he's a self-proclaimed gold bug. He said things such as, I want to remonetize the asset side of the balance sheet for the U.S. government. Now, he backed off saying it's not gold, it's not gold, but I'm thinking he's going to remonetize gold.
Physical gold deliveries have increased significantly, according to recent COMEX statistics, with warehouse stockpiles dropping from 45.1 million ounces in early April 2025 to 43.6 million ounces by mid-April, a $4.8 billion decrease. 8 days in a row, traders have been repatriating metal, some of them back to London, as a result of the reduction of U.S. import tariffs on gold. This is the first such run in 14 months. Demand is being driven by trade disputes, slowdown fears, and global tensions. Persistent drops in COMEX stocks may indicate a physical scarcity and lead to a price increase. Treasury Secretary Scott Bessent stated on February 3, 2025, that the United States intends to monetize the asset side of its balance sheet in less than a year. Although a revaluation of gold is not currently being considered, expert Andy Sheckman thinks it might eventually entail remonetizing gold. Highlights that global trade tensions, particularly US-China tariff wars, have rattled markets. Gold, a classic safe haven asset, is seeing increased interest as investors hedge against economic instability. The Moody's downgrade of the U.S. credit rating in May 2025 further fueled this trend. China's gold market is heating up, with speculators and central banks boosting demand. Reports suggest Chinese investors are diversifying away from US dollar assets, and physical gold is a prime beneficiary. Earlier this year, fears of US tariffs on gold imports prompted traders to stockpile bullion in COMEX warehouses. Now, with some tariff exemptions like those for Switzerland, gold is flowing back out, tightening US supplies. Moreover, China has moved forward independently, rebranding the project as BRICS Bridge. This new version is already fully connected with 11 Southeast Asian countries and 5 Middle Eastern nations, collectively representing 38% of global GDP. The 17th BRICS summit held in Brazil's Rio de Janeiro has come to an end. The one big takeaway from the annual summit was that the leaders of the BRICS countries have decided to move forward on implementing a cross-border payment system, the main global interbank payment network. Gold remains central to the plan, signaling a shift toward a settlement system less dependent on the Western financial framework. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think gold is becoming central to a new system. Call it the skeletal system of a new monetary order, whether it be in the BRICS or whether it be in the United States. Last year, the Bank of International Settlements pulled out of Project Enbridge at the 12th hour. They had been developing it with the Bank of International Settlements Innovation Hub with China, Hong Kong, Thailand, and the United Arab Emirates. And the Enbridge technology is a cross-border payment system that allows for instant settlement, 7 seconds, a 98% reduction in fees, cross-border between central bank digital currencies from country to country, free from SWIFT intervention. And the fifth participant in the Enbridge technology is Saudi Arabia. And things were progressing to the point where Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, the BRICS New Development Bank, said, we've agreed in principle to a new settlement system called the unit. It is a digital representation of a basket of 60% BRICS plus currencies and 40% gold, deliverable upon request. And things were progressing. And you could see that gold was becoming central to their theme. And we've agreed upon it in principle, she said. We're ready to roll it out over Enbridge, which is operational. And at the 12th hour, in what amounts to espionage, James Bond movie, the BIS, which is a Western institution, pulled out and said, we're pulling the plug on Enbridge. We can't, and mind you, this is largely a Chinese technology, although through the Innovation Hub it was refined and thoughts of rolling it into the Western system as well. And they say we can't be involved in any platform that will allow countries to sidestep Western sanctions. And so they pulled out. Now it's as if they just realized that Russia was the R in BRICS. And then things went very quiet. Now, since then, we've seen some very, very significant things that I think are largely being ignored by the West. And in particular, the new Enbridge, let's call it repackaging, it's called BRICS Bridge. And BRICS Bridge has now been rolled out officially by China. And they're calling it the renminbi cross-border payment system, first and foremost. So what I believe is happening is because Trump is putting so much pressure on the BRICS, they're kind of stepping out for a second, maybe waiting him out and letting China take the lead in developing the rails of this new system. And China came out about 3 or 4 weeks ago and said, and I've talked a lot about this, that, hey, we have connected with the new bridge technology, fully connected and integrated, 11 Asian countries, ASEAN, these are the countries from Southeast Asia, and 5 Middle Eastern countries. This represents 38% of global GDP.
Russian Foreign Minister Sergei Lavrov confirmed that several initiatives are underway within the BRICS framework to develop alternative independent payment platforms. Crucially, he stated that countries outside BRICS will also be able to access these systems once established. At the BRICS outreach session, there is an ongoing work to create a cross-border payment and settlement infrastructure. And he emphasized the drive to build a more stable global economic architecture, anchored in multipolarity, where trust in Western-dominated institutions is diminishing. BRICS countries, he noted, are positioning themselves as key drivers of this transformation. The Shanghai Gold Exchange, SGE, officially launched its first offshore, international board-certified gold delivery vault in Hong Kong, and he believes this marks a major milestone in facilitating RMB-denominated gold trading and attracting global investors seeking physical delivery in a stable jurisdiction. While the Hong Kong vault is now operational, no confirmed updates yet on vaults in Saudi Arabia, under construction, Moscow, St. Petersburg, Dubai, or elsewhere along the Belt and Road are publicly available. These remain future objectives in China's broader strategy to build a decentralized, resilient gold settlement infrastructure. The new Hong Kong vault, operated by Bank of China, Hong Kong, enables RMB-denominated gold trading with cash or physical settlement. Analysts see the launch, along with 2 yuan-denominated gold products, as a major step in Beijing and Hong Kong's push to expand global commodities trading and potentially erode Western monetary dominance. Let's revise the interview.
You had Sergei Lavrov, who was in meetings with Dilma Rousseff the year before, when they both came out of the meeting, said, we've agreed in principle to this new settlement system called the unit. He's been closely involved in all of the BRICS meetings since day one. And a lot of the technology or a lot of the ideas, the infrastructure of how they would roll things out were his. So in any case, he comes out and says, we're going to issue this BRICS technology, this cross-border payment system. We're going to issue it to non-BRICS members, not just the BRICS. A lot of the pushback with the BRICS has been they're not big enough. When he said that, after they had already connected the Asian countries, it became very obvious that this is bigger than people are thinking. And I said publicly they're going to roll it out to the Belt Road Initiative, which it appears they now are. So what I'm getting at is that this system, which would compete with the SWIFT, will settle in 7 seconds, not the 3 to 5 days it would take these countries to go back and forth from dollars, from their currency to dollars and the other currency, and back and forth at a 98% reduction in fees. And they're going to open it to the remainder of the world. It's just not compatible with the pound, the euro, or the dollar. Subsequently, BRICS Pay is also being rolled out to the Belt Road Initiative, which is 75% of human population, 50% of global GDP. This is the cross-border business to business, consumer to business, small bank to small bank, the retail side of BRICS' agenda. Again, China is doing the central bank side. They're calling it the renminbi cross-border payment system, but it is the BRICS bridge. It is the M-Bridge technology. But rather than antagonize the president, they're letting China do it first. The key to the third piece of this puzzle, the key to it all, at the same time, we get the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults around the Belt Road, starting with Hong Kong. The vault is complete. The next one is Saudi Arabia, which is under construction now. The idea between all of this is to allow countries to trade cross-border with one another in their own central bank digital currencies. We already have 16 countries officially signed up outside the BRICS, the Asian countries and the Middle Eastern countries, and to settle imbalances in gold through a series of multi-jurisdictional vaults, whether it be the expansion of the Shanghai Metals Exchange, Hong Kong, which is operational. And by the way, the yuan is immediately convertible into gold, not having to first convert to dollars as you would have in the past. So they're saying, okay, China will trade with Saudi Arabia. They'll send them digital yuan for their oil. Saudi Arabia can then immediately convert that into gold if they wish. Right now in Hong Kong, soon to be in their own country, in these vaults as they expand through the Belt Road, very ambitious endeavor, but ultimately connecting to a whole series of vaulting networks, whether it be in Moscow, in St. Petersburg, in Dubai, the new BRICS gold exchange, Shanghai, and the vaults that we see throughout the world. It enables these countries to trade locally in 7 seconds, boosting their own monetary infrastructure, free from SWIFT intervention, and settle any and all imbalances in gold. It's genius. It truly is. And I really hammered this home over the last month. And then yesterday we get an article, or 2 days ago, from Forbes that pointed out that China is now just the third largest trading partner for the United States. And in May, their numbers were less than 6% of trade, which is the lowest level, Daryl, in over 20 years. And the article went on to say that the Asian countries, these same countries that are now hooked up and actually in operation with the new bridge technology, together have a population twice as large as the United States, over 700 million people. They have the fastest growing consumer markets in the world, the fastest growing middle class in the world. And as a group, get this, these countries are now China's largest trading partner by far, way ahead of the EU and the United States. Let me just say that once again. They're connected, and they're the largest trading partner of of China, and they can trade cross-border in 7 seconds with no SWIFT interference, no SWIFT recognition. They won't know what's going on, and any imbalances will be able to be settled immediately in gold. This is a massive deal for the BRICS. All right, so that more or less covers the BRICS side of things, where you have, in essence, an expansion of the Shanghai Metals Exchange, connecting with other metals exchanges already in operation in Dubai and in Moscow, the new one that just was built in St. Petersburg. And the ambitious goal over the next year or two is to create this skeletal system of vaults, multi-jurisdictional, so it's not all held in one location like the Bank of England, who had the power to say to Venezuela, yeah, we're not going to give you your gold, thanks anyway, move along. So you want to be able to keep gold in various jurisdictions to mitigate any risk, and then be able to settle imbalances through trade through this entire network. It's important to remember that the Belt Road Initiative, these countries are not in the BRICS, nor is the Shanghai Cooperation Organization, the largest regional military and financial group in the world, or the Eurasian Economic Union, all the countries that end in STAN, a Russian endeavor like Kazakhstan. These countries are all very, very, very connected to the BRICS. In fact, the president of Belarus has been screaming forever that the Shanghai Cooperation Organization, the Eurasian Economic Union, should meld with BRICS. The Belt Road countries, 150 plus countries, 75% of human population, 50% of global GDP. They're not in the BRICS, but they are very connected with the BRICS.
A changing global financial order is indicated by rising physical gold demand, COMEX outflows, and strategic actions by China and BRICS. Gold is recovering its monetary significance as the United States deals with trade conflicts, credit downgrades, and possible balance sheet monetization. A shift towards settlement methods less dependent on the dollar and SWIFT is indicated by China's offshore gold infrastructure and BRICS-led payment systems. With gold at the center of a new trust-based economic structure, this multipolar movement has the potential to revolutionize international trade. Will the BRICS gold-based payment systems hasten the demise of the US dollar as the world's dominant currency? What effect would persistent COMEX gold outflows have on world gold prices over the upcoming year? Let us know your thoughts in the comments. If you enjoyed this video, give it a like and subscribe for more updates. Thanks for joining us on this journey.
If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox.
If paper gold investors suddenly demanded real delivery, the system would collapse fast. Since leased gold isn't actually in their possession, counterparties would be forced to scramble for metal in the spot market, but there isn't nearly enough physical gold available to cover more than a fraction of paper claims. That kind of rush would trigger a panic, with prices shooting toward $25,000 an ounce almost instantly. It's likely someone, maybe Scott Bent, explained this fragile reality to Trump and Musk, which is why they backed away from the idea of making a public spectacle at Fort Knox. Mike Maloney, best-selling author of Guide to Investing in Gold and Silver and founder of goldsilver.com, reveals that China has just issued a groundbreaking mandate requiring its largest insurance companies to allocate 1% of their assets into physical gold. This rule is being funded by reducing U.S. Treasury holdings, accelerating China's shift away from the dollar, and creating massive new demand in the gold market. At current prices, this would consume 15 to 20% of annual global mine production, an amount so large that it virtually guarantees upward pressure on prices. With mine supply stagnant, this structural demand could push gold far above its current record highs in the years ahead. Meanwhile, momentum is building elsewhere. India's pension regulator is considering allowing retirement funds to invest in gold ETFs. Indonesia is weighing limits on gold exports to preserve reserves. And Florida has legalized gold and silver for transactions. Mike Maloney, at the same time, also highlights that Japan's collapsing yen has driven gold to record highs there, tripling in value over the past 5 years. Globally, gold still represents just 0.5% of financial assets compared to a long-term average of 2%. Even a simple return to historical norms would multiply demand several times over, signaling the early stages of a potential gold supercycle. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old actually. So a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold, And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves. But this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but, Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation.
Mike points out that silver remains an extreme bargain at around $40 an ounce when compared to its inflation-adjusted 1980 high of $1,640. At the same time, questions about the accuracy of official inflation data have grown louder. Analysts like John Williams argue that government changes to CPI calculations in the early 1980s distorted the true picture of rising costs, which also explains why long-trusted financial models suddenly stopped working. Gold's steady rise since then, they say, simply confirms this hidden inflation and highlights how far the dollar has fallen since the Federal Reserve was created. Meanwhile, gold market dynamics revealed deeper cracks. The physical gold inventory has been flat or declining even as gold prices make new highs, raising suspicions that major players are quietly pulling gold out of ETFs. On the political front, Trump has floated bold ideas like issuing gold-backed treasury bonds to challenge the Fed's authority and restore confidence in the dollar. Calls to audit America's gold reserves are also resurfacing, as many now frame the issue correctly. It's not so much that gold is skyrocketing, but that the US dollar has been relentlessly devalued and is today worth just 1/3,300th of an ounce of gold. Now let's revise the interview.
Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the colony, the U.S. colonies, the American colonies, not the U.S. didn't exist yet, 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young, again, GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's Goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing it.
In short, gold and silver are no longer just safe haven assets. They're becoming central to a global financial realignment. From China's bold mandates to structural cracks in paper markets, the stage is being set for a historic revaluation of precious metals. With supply constrained and demand surging worldwide, the question isn't if prices will rise, but how fast and how far they'll go. Do you think China's gold mandate could trigger similar moves from other countries or institutions? Is silver, with its extreme undervaluation, the more explosive opportunity compared to gold in this coming cycle? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. of what it's insane is what the CP lie is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So it's gold and silver. Gold, if you use the CP lie, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened, because so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid 80s, all of his models stopped working. And he was wondering why. And he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and used what he uses for this alternate CPI is the government numbers from World War II to 1982, the method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad, it seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in an airport. Oh my God, it's just unbelievable. So,
yeah,
gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold, put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. Global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
Pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CP line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve, and they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CP lie, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CP lie is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing. But you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been? I can buy so much more real estate, stocks, just about everything. I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200, that still would not. Yeah, compared to those other financial assets, that 200 wouldn't be in a bubble. The CP lie, the current one, the low CP lie, is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book. There, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400. And people changed their preference in late 79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.